We all love a dividend growth stock. But what is the best dividend growth stock to buy right now? I made a list of 6 great dividend growth stocks with a potential to be a long-term hold for you. Right now I own 3 out of 6 of these stocks, but the other 3 are on my buy and watch list. So I will add them to my portfolio this year probably. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. Please subscribe to join the community and to receive multiple analysis every week, where I will tell you everything you need to know about the stock market. So, the first company on this list is Abbvie, a 3.5 dividend yield healthcare stock with some great upward potential. Abbvie is a pharmaceutical company with a strong exposure to oncology. The company's top drug is Humira, represents close to half of the company's current profits. The reason why I chose Abbvie is because of the dividends and because of the diversification. If we check the year-to-date chart, we see that Abbvie has increased more than 70% year-to-date, compared to a almost 7% loss year-to-date of the S&P 500. So besides receiving a 3.5% dividend yield every quarter, the stock price is also performing very well and you got your diversification. If we check the fundamentals of this company, we see that Abbvie is a 263 billion market cap company with a PE ratio of 23 and a forward PE ratio of 10. You want to buy a dividend growth stock for a fair valuation and you don't want to pay this big premium. So Abbvie is almost fairly priced based on the PE ratio. Profit margin is at 20%, which is great. They make enough money to keep the dividends alive. The management effectiveness is also looking good, so that's another great thing. The 12 trailing month revenue is sitting at 56 billion and the quarterly revenue growth is year over year at 7.4%. So the revenue is increasing year over year, which is also very important. In this chart we see that the revenue is going up nice and steady, so that's a great thing. One of the requirements I have for dividend stocks is an increasing free cash flow, and Abbvie does a really good job there. Free cash flow is used to pay down debt, buy back shares and also to pay dividends. So in order to maintain and grow the dividends, the free cash flow must increase every year. Abbvie does a good job there. If we check the dividend scorecard, we see that Abbvie pays a 3.5% dividend yield and a $5.64 a share annually. The payout ratio is sitting at almost 42%. I think this is at a healthy level, and when the free cash flow is increasing, you don't have to worry about the payout ratio right now. The 5-year growth rate is sitting at almost 18%, so also very nice. And Abbvie did increase the dividends for 8 years in a row. For me, Abbvie is a buy if you are a dividend investor. Revenue is increasing, free cash flow is increasing as well, and they have this high dividend yield of 3.5%. Besides having this great dividend, the stock price is also increasing a lot, which is also a thing I really like. Next company on my list is Starbucks. I recently bought this stock and I made it a top 5 holding in my portfolio. One of the main reasons was because of the valuation and of course because of the dividends. Starbucks pays a 2.2% dividend yield and has a 16% 5-year growth rate. Another great thing about Starbucks is the diversification and the moat they have, in my opinion. I don't have to explain what Starbucks does, I guess, so let's dive in immediately. Starbucks is down roughly 26% year to date. Not because of fundamentals, but just because of all the things that are happening right now in the stock market. But compared to the S&P 500, it's quite a lot, because the S&P 500 did only fall 7% year to date. So, Starbucks is a 95 billion market cap company with a PE ratio of 22 and a forward PE ratio of 24. Profit margin is looking great to me, sitting at almost 15%. Management effectiveness is also fine in my opinion. Starbucks has a 30 billion 12 trailing month revenue and almost a 20% quarterly revenue growth year over year. The revenue went down just a little bit in 2020 because of the coronavirus, but when things calmed down, the revenue went up immediately. One of the great things about Starbucks is the share buyback program. Starbucks is buying back a lot of shares, which is a great thing if you are a dividend investor. When a company buys back shares, the total amount of dividends that are needed to pay will become less. So instead of paying 10 shares a dividend, they need to pay 9 shares a dividend if they buy back 1 share. This will lead to easier maintaining the dividends and, more importantly, easier to grow the dividends. So Starbucks pays a 2.2% dividend yield of $1.96 a share annually. The payout ratio is sitting at 56%, and the 5-year growth rate is sitting at almost 16%, which is a great thing. Starbucks did increase the dividends for 11 years in a row. As mentioned in the beginning, I did bought Starbucks shares a while ago, and I made it one of my bigger stocks in the portfolio. This is because of the juicy dividend and because of the valuation. The stock has come down a lot lately, so I thought this was the perfect time to buy some Starbucks stocks. I will definitely buy more shares in the coming months. Third company on the list is Broadcom, a 2.7% dividend yield stock with almost a 40% 5-year growth rate. How impressive is that? Next to that, the stock climbed a lot in ticker price in the last couple of years. Broadcom is the combined entity of Broadcom and AVGO. Boosts a highly diverse product portfolio across an array of end markets. AVGO focused primarily on radio frequency filters and amplifiers used in high-end smartphones such as Apple iPhone and Samsung Galaxy devices. In addition to an assortment of solutions to wired infrastructure, enterprise, storage, and industrial end markets. Legacy Broadcom target networking semiconductors. The stock is down 9% year to date, compared to the 6% of the S&P 500. All the reason to keep an eye on this big dividend growth stock. So, Broadcom is a 235 billion market cap company with a PE ratio of 32 and a forward PE ratio of 16. The profit margin is sitting at 27%, which is fine by me, and the management effectiveness is also looking great. The 12th trailing month revenue is sitting at 28 billion, and the year-over-year quarterly revenue growth is sitting at 15%, also looking good to me. If we check the revenue growth over the past years, we see that it has increased big time. So that's a really good sign, and to be honest, it looks like it's going to grow a whole lot more from here. One of the great things about Broadcom is the increasing free cash flow every year. This means it's more easier to maintain the dividends and especially to grow them in high amounts, which they do. So if we check the dividend scorecard, we see that Broadcom pays a 2.68% dividend yield and an annual payout of $16.4 a share. The payout ratio is sitting at 51%, so there's plenty of room to invest the other part of the free cash flow back into the business. The 5-year growth rate is really impressive. It's sitting at almost 40% and the payout ratio is still at a healthy level. How great is that? Broadcom did increase the dividends for 11 years in a row. Right now I don't own any shares of Broadcom, but I have them on my buy list. I think they are in a buying area in terms of valuation, but as a dividend investor, I think with this 5-year growth rate you cannot ignore them. I will definitely buy some shares this year. The next company on this list is HomeDepot, a 2.3% dividend yield stock which gained a lot during the Roni virus because of all the people investing in their home. HomeDepot is the world's largest home improvement specialty retailer, operating more than 2,200 warehouses, format stores offering more than 30,000 products in-store and 1 million products online in the United States, Canada and Mexico. Its stores offers numerous buildings materials, home improvement products, lawn and garden products and decor products. The stock is down 22% year to date, and that's a lot compared to the 6% decrease year to date at the S&P 500. And also the reason why I included this company in the list. They pay this juicy dividend and it's also very valued in my opinion. Right now I don't own any share of HomeDepot, but I'm going to buy this stock this week, so let me explain why. HomeDepot is a 343 billion market cap company with a PE ratio of 21 and a forward PE ratio of 20. The profit margin is sitting at 10% and management effectiveness is looking great. So far, so good. The 12th trailing month revenue is sitting at 151 billion and the quarterly revenue growth year over year is sitting at 10%. In this chart, we see that the revenue did take a big jump in the last couple of quarters, so that's also a great thing. Another great thing is that HomeDepot buys back so much shares, which will lead to easier maintaining and growing of the dividends. So that's also a great thing in my opinion. Next to that, HomeDepot has a really nice and steady increasing free cash flow. This also enables them to maintain and increase the dividends more easily. Another great ingredient for a dividend growth stock. So let's check the dividend scorecard. HomeDepot pays a 2.3% dividend yield and an annual payout of $7.6 a share. The payout ratio is sitting at 44%, which is fine by me. The 5-year growth rate is sitting at 18%, and they grew the dividends for 13 years in a row. As mentioned before, I don't own any shares right now, but I will buy my first HomeDepot shares this week. In the coming months, I will slowly increase my position from here and keep the dividends coming from this great company. For me, definitely a buy. Number 5 on this list is UPS. A 2.8% dividend yield stock with not the greatest 5-year growth rate, but they had this massive increase of dividends, around 50% in the beginning of this year. So maybe this dividend will grow even more from here. All the reason to add them to my list. As the world's largest parcel delivery company, UPS manages a massive fleet of more than 500 planes and 100,000 vehicles, along with many hundreds of sorting facilities, to deliver an average of about 25 million packages per day to residents and businesses across the globe. UPS domestic US packages operations generate 62% of the total revenue, while international package make up 20%. So, UPS stock is nearly flat year to date in terms of ticker price, and in my opinion, fairly valued right now. UPS is a 177 billion market cap company with a PE ratio of 13 and a forward PE ratio of 15. The profit margin is at 13% and management effectiveness is also looking good to me. The 12 trailing month revenue is sitting at 97 billion and the quarterly revenue growth year over year is sitting at 11%. In this chart, we see that the revenue is increasing very nice and steady, and it's highly likable the revenue will go up even more from here. More and more people are buying stuff online, and also packages need to be shipped. Especially during the coronavirus, the revenue of UPS climbed a lot. I don't think they will grow in the same ratio as they did during the coronavirus, but I think they will pick up the steady pace they had before. But that's fine by me. UPS is buying a lot of shares back, which will lead to an easier maintaining and growing of the dividends. So that's also a great thing in my opinion. So if we check the dividend scorecard, we see that UPS pays a 2.78 dividend yield and an annual payout of $6. The payout ratio is sitting at 33%, so there's enough room to maintain and grow the dividends. If we check the 5-year growth rate, it's only sitting at 7.6%, but if we check the last increase in the beginning of 2020, I think you can understand why this is a really interesting dividend growth stock. UPS did increase the dividends for 22 years in a row. I think UPS is a really interesting dividend growth stock because of the recent increase, but also because of the huge share buyback program and increasing revenue. I think you have a very solid, fair valued company with a great dividend. So far, UPS is a buy for me. Last but not least, we have Domino Pizza, a 1.1% dividend yield stock with a 20% 5-year growth rate. Can this be a future big dividend cash cow? Let's find out. Domino Pizza is a restaurant operator and franchisor with nearly 90,000 stores across more than 90 international markets. So, Domino's is down almost 30% year to date, which is quite a lot compared to the 6% of the S&P 500. But to be honest, I think this stock was highly overvalued back then. And right now, they are entering the more valued area. Domino's is a 13.9 billion market cap company with a PE ratio of 28 and a forward PE ratio of 26. The profit margin is sitting at 11% and the management effectiveness is also looking good to me. The 12 trailing month revenue is sitting at 4.3 billion and the quarterly revenue growth is sitting at minus 1%, which is a thing to keep in mind. If we check the revenue growth over the past years, we see that it's nice and steady, so I'm not that worried about the revenue growth, to be honest. A great thing about Domino's is the huge share buyback program, which will lead to an easier maintaining and growing of the dividends. So that's also a great thing in my opinion. Next to that, free cash flow is also increasing a huge amount, which also will lead to easier maintaining the dividends and even increasing them. If we check the dividend scorecard, we see that Domino's pays a 1.1% dividend yield and an annual payout of $4.4 a share. The payout ratio is sitting at 27%, meaning there's enough room to grow the dividends even more. The 5-year growth rate is sitting at almost 20%, and they did grow the dividends for 9 years in a row. For me, Domino's could be a buy if they came down just a little bit more in stock price. Right now, I do think they are still a little bit overvalued, so I would love to see them at lower prices. The dividends look great though, so from a dividend perspective, I think they are a buy. So, this is the end of the list. I think all these stocks are great dividend stocks in different ways. Some are already having this high dividend yield and some of them are growing in huge amount. All of these stocks have an increasing revenue growth, which is very important. Next to that, I love to see when a company buys back shares, which will lead to easier dividend growth. I will definitely add shares of these companies to my portfolio, and the first one I'm going to buy is HomeDepot. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.